what a lot of people think is they think simply underpricing means the actual price that it's listed for. Now, what you're really looking for here in property is a couple of things, and this is how I'm interrelating it. Now, pricing in property, what you're really looking for is value. It's not the actual listed price. So it's different from the price listed. Now, funny enough, I actually think when you're looking at properties, the least important thing is the price it's listed for. It's the absolute, and it's where fallacy that everyone falls for. Now, I've found properties before, I kid you not, that are listed for, let's say, $1.2 million. Now, I wouldn't pay a cent over $950,000 for them, right? They are listed 25 to 30% over their market value. I kid you not. I wouldn't pay that. But people then go in and pay $1.2 million for them, and they're like, oh, I got a great deal. I got it for the listing price. Sometimes they might even pick it up for $1.1 million. They're like, oh, I've got a really good deal here. I've got it under the listing price. But it's like, no, the value of that thing is nowhere near where they're listed for. You've got a rip-off, but you're thinking you get a good price for it. Now, on the contrary to that, I've also picked up properties where it's been listed for $950,000, but I know it's worth $1.3 million, and we've bought it as well for $1.1 million. Now, why often on these properties you have to pay more for them is because people aren't stupid. It's the people that bid up these properties, often you'll see at auctions. Now, some people are idiots. They're emotional, right? But if you see someone who's a long-term investor, they are seeing the true value in the market, or especially if it's a holding company, someone like the CBA buying it, someone like a massive, assets under management company buying it. I do see these people come in and buy their reps of them. The reason they bid these up is because they know, despite everyone in the market, that it is worth much more than it's listed for. So sometimes I've had a property listed for $950,000. We've bought it for $1.1 million. We've then even gone and got a bank val, and it's come back at $1.25 to $1.35 million. That's happened before. And I've said to clients, and clients on the way in, don't get me wrong, sometimes, it's not all the time, most of mine trust me very well, but I mean, on the way in have said, oh, you sure we're not overpaying for this? You sure we're not doing this wrong? We're sure we're not doing that wrong? I'm like, no, trust me on this. Then we buy the property and get the val done, and like, oh, thank you so much. We've just made $250,000 on the way in for a property or something like that, and they're really happy. But where I'm getting at this is that's the value in property. It's not really anything to do with the listing price. It is the value is the total thing you're looking for. It has nothing to do with what it's listed for. Most agents aren't even property investors or don't even own properties themselves. So, I mean, most have no idea what they're talking about here alone. So, I mean, if you're buying the right pocket of the suburb, the right property, let's say the suburb is $1 million, the property is probably worth $1.2 million. It's well above the average property. If that's listed for $1,050,000 to 1.1, and you get it for anything between that, you've made more than $100,000 or anything more than $100,000 on the way in. So that's value. That's what I'm talking about in value in terms of price listing. Secondly, a thing we should get into is underperformance and recency, but overperformance generally. So what I'm saying here is, what I generally will look for is an area that recently has performed very badly. And Melbourne, as I've said in the past, is a perfect example of that. And that's the general market. The suburbs that are even better on the general approach of the market. So, I mean, I'll get into some suburbs in a few minutes, I guess, about this, but underperformance and recency, overperformance generally. The suburbs done nothing for, let's say, 8 years. Suburb long-term does 10%. What do you think is going to happen in the future when that reverts? It always happens. It'll happen in the future. It'll happen again. I'm telling you that right now. So that's what I'm talking about. Don't have, should I say, recency bias or confirmation bias persuade you. Don't listen to a broke journalist on the news either. They don't know what they're talking about. Don't listen to a person at a barbecue, a family barbecue. They tell you, oh, I know about property. Okay, you were born in the 1970s and you only own one house. You're not even worth that much in the easiest generation that has ever been to own property. So how the hell would they know what they're talking about when they don't even have what you're looking for? You need to talk to people who own 10 plus properties in the right areas. That's who you need to talk to, not someone who doesn't own anything, okay? So don't, as I said, the two biggest things, don't fall for confirmation bias, don't fall for recency bias. They're the two biggest killers in this. Third out of my last 2 points is it relates to long-term strength of the market. Now, when I'm saying long-term strength, there's a couple key things to this, right? So long-term strength directly relates to the underlying long-term diversified demographics of the market. So Sydney and Melbourne are your two perfect examples of this because you have very diversified industry that is inherently government backed, that has to be there. So, for example, your finance in Melbourne, a good example is your finance industry. 3 of the 4 big banks are down there, right? You have a lot of tech. You have a lot of financial firms. You have big hospital precincts. You have government administration jobs. You have, don't get me wrong, it's a bit hit at the moment, but you have trade, construction, both of them as well. You also have education, major education, well-renowned unis there, right? Those are massive industries that are all diversified, mainly in this one market, right? And they pay high amounts of money. They're not small amounts of money. Also, on top of this, you have international demand, right? Melbourne is an international city, is not a domestic city. It is on it is on pretty much within the top 20 of almost every most livable city. I'd say, most livable cities one, trendy cities is another. I mean, cities that I'd say as well feature in even best cities to live in terms of not only livability but actual income to where you can get jobs. Easy to get a job generally as well. So that's another thing. Long-term strength of the market too. Capital growth. What is the long-term capital growth of the market? Is it high? Is it low? And I'm not saying like last 10, 15 years, and that's an issue because since the COVID boom, I mean, everyone thinks Townsville's a good long-term capital growth market, but I'm telling you, it's one of the worst in the whole country. Melbourne is the best in the entire country. I'm telling you that right now. Long-term, you can look at 30 years. You can even go back to literally the 1890s, right? I found data in the 1890s that can show land sales right to today's price of literally 9.1 to 9.2% capital growth. And that's 130 years worth of capital growth, okay? That's long-term strength of the market. So that's another point. Don't fall for the recency bullshit again that you'll hear on the news and you'll hear from most people at a barbecue, or you hear from a cash flow investor who has made money since COVID when you could have thrown a dartboard at the Australian map and made 30%, okay? Don't listen to that nonsense. Final point. It is strongly correlated to long-term land value appreciation. So for people who are well-versed in property and understand investing in a long part, what you're buying really is the land value. Now, I'll put a few caveats to this. Land value does not mean land size. Perfect example. I'd rather own 1 meter squared in North Bondi than 1,000 meters squared in Broken Hill. Now, a lot of people say, what do you mean? A land value of 1 meter squared in North Bondi is probably triple, if not 10x of the price. I don't know what the price of 1,000 meters squared is in Broken Hill, but no one cares about it and it's not going to do anything. Like, yeah, you might pick up something for $200,000 today. In 30 years, it'll be $350,000. Who gives a shit? North Bondi, yeah, it might be $4 million today. In let's say 30 years, 20 or 30 years time, it's probably going to be like $20 million or something, or $16 to $20 million, probably more actually. I'm probably even undershooting it, but you get what I'm saying here, right? Now, why land value is important is the real asset is the land. It's not the property. Land is what goes up in value, not the property. The property actually but it actually depreciates, in value. But the land inflates in value. So, I mean, if you're buying an asset that's very close to its land value and it has a house on it, you're basically buying it for below its replacement cost, because a minimum house today costs like $500,000 to build. If you buy a house in Melbourne, and there's good examples of this. I mean, I bought one literally before for a touch under 1.1 million. The land value was $1,050,000, right? And I mean, you could not, what I had on that would be, I mean, a value was said it would cost $950,000 to rebuild that today. So, I mean, you're effectively buying it well below its actual replacement value there, right? But the thing is with land value as well is it's generally the highest capital growth locations in inner city markets that have the highest land value. So long term, that's where you get the land appreciation. This is why, as I previously discussed, that over the long term, right, your actual, land and appreciates most in these inner areas. That's why the last example where I said I can find a suburb in Melbourne where there were blocks of land literally selling for, I mean, it was literally under £10 back in literally the 1890s, under £10, right? And they're like $2.5–3 million today, right? The same block of land. So that's pure land appreciation. And he's not that they've built a castle on it in the 1890s that's 200 rooms. That's pure land appreciation. So capital growth and value in property strongly correlated. It's almost 1-to-1 of consistent long-term land value appreciation. That's something you need to know and very, very important in the long term.